Good afternoon, fellow people. Today is currently Wednesday, right? And you can see it's 12:04, a lot earlier than we normally stream. Today, I want to stream a little bit earlier because I want to do quite a few more sessions. We have now 7 days in this month, and as you know, I expect to do what I expect. I expect so 7 days, 30 episodes. It's like 4 a day now. It was meant to be 3 a day, but we only did like one over 2 days. So anyway, we expect to do multiple today. I'm gonna take a break, maybe eat, come back, and then go again. But for now, I want to just get into obviously making more progress than last time. So if you don't know, we're building multiple businesses at the moment, so it's a bit difficult as to why I'm streaming late. Normally I'll be streaming like between 6 and 9 a.m. because that's when London session opens. We're going to do a mixture of trying to implement what we learn already in the markets. We're also going to be looking at um, previous episodes we did, summarizing it. We also want to look at the previous episode, and then, of course, to start actually studying episode 13. But before I start, as you know, like I said earlier, we're making multiple businesses. My goal is to make one new business a month. Not necessarily launch a business a month, because sometimes, for example, like the business I'm doing right now, it costs, it's probably like going to be a 2-3 month job to even start it, which is extremely difficult. And I haven't really been updating this as much, mainly because I'm not using it as much, but that will pick up on May 8th. That's when I want to start doing more videos and daily posts. I want to start that on May 8th, as well as start on a live account again and show you my trades. If you don't know, this the London page. It's called @ch.com. You can get there through the link in the description or typing it into the search bar. This is what it looks like. This is the interface. Interface will be going through improvements over time. I think it's very good. You have the date and time. You have your account or account strategy up here. You can filter between every strategy or account, as multiple people have multiple trading accounts. Whether it's a funded account here, a personal account here, a scalp account here, different models, etc. You then also have filters by long, short, sessions, entries, your stop loss, your exits, your pips, your risk reward ratio, your P&L, your whether you've had a partial close or you fully closed. You followed your rules, tags. You can even sort by tags, and you have your screenshots over here, but you can sort by tags over here. And then you can also have your screenshots. You'll be able to click on tags and sort by it in the next update as well. You also have this calendar format, which is the same thing, but it gives you a summary of the week, which you can change to the quarterly, yearly, as it can help your view. And you can also, of course, filter through each month and the sessions, and you have some filters over here. You then have analytics, which shows you, for example, here with activity heat map, which shows you how much you traded and also if it was a profit or loss. You then have other graphs like a radar chart. You have equity curves. You have P&L by pairs, drawdowns, win rates by sessions, by daily P&L, all these types of stuff. Pro users get an AI agent which allow you to review your journal. You can ask specific questions, such as which session am I most profitable in. It has access to all of your journal and it can give you information based on that. You then have cloud storage if you want to download your log trades to your own website or maybe like a Google Sheet, for example. Or Excel sheet. You can also get into contact over here with any of these features. You have an ideas panel where you can share your ideas, and if it's highly voted, I will focus on it for the update of the week. And the study journal coming soon, where you can build models, practice models, and it will help you to use side by side when you're looking at the markets. And I'm going to personally do it myself, so that I can also kind of see and gauge what I would like to do. And I think one of the things that's got this website this far is that I am using this website in a manner of which I would like to see these things. So feel free to sign up. It's free to check it out, and then you have some unlimited statuses here. You'll see what you have when you go to the cloud storage over here. So Asset Homes is what we're building. This is the project that we was working on last week. Took a lot on me, won't lie, but it's quite good. You should be able to. I don't know if I can can find it or not. Perfect. So this is the review. Well, I mean, this is the account right here. So this is the property that we currently have. It has been upgraded a little bit, but the tables are different. To be fair, that's pretty much the same. And pretty much the same. We've upgraded some of these things here. There's a different kettle. There's a what else? There's a toaster here as well. This bed is the same. This is the same. This is different. We changed the beds here. Beds are much better now. Changed these beds as well. So yeah, this is the property. I think there's 4 more pictures still somehow. Cool. So yeah, I think 86-inch TV as well. If you are willing, try sign up. It's great. And yeah, I think you guys will enjoy it. Okay, anything else? No, that's all. Okay, there. Okay. Feels weird looking at the markets again. There's like so much knowledge. Like looking at this is just weird to me. Okay, let's go over episode 12. So market structure was the form or theme, I should say, for the previous episode being episode 12. We are now looking at, we're introducing to the concept of a lower time, a larger time high, a short time high, an intermittent time high. And we are looking at the effects on that in a smaller time frame, at least for previous episodes, and how price connects these two and the relationships they can have over time when price is moving. So we defined what all of them were and how to determine them. We're gonna do short term high later, which I don't know, this feels like it's off centered somehow. And I'm just clean it up a little bit. What happened? Okay, yeah. So essentially, there's 2 things about the intermittent turn high, which is very crucial. Number one is that it's when there is a short term high below either side. So short term high is when we're looking at the extremes of a price, extremes of price, and then we're looking at the 2 candlesticks beside it. So we look at the extreme, which is over here, and then we see this candlestick's high is below it, and this candlestick's high is below it. That makes this a short term high right here with this candlestick and that extreme here. This is another extreme. So this technically would have been a short-term high as well, short-term low rather. High is this previous candle's high is above it. This next candle high is above, low is above it, and low above it here. So this will be a short-term low, but we made it a larger-term low because on a daily time frame, I believe that's what it was shown as the low itself. The common theme is that with any intermittent term, short-term, long-term, high or low, it has to have to the side of it a candlestick if it's a high with both previous and forward, both adjacent candlesticks have to have the high lower than the high in the middle. And if it's a low, the adjacent candlesticks must have a higher low than the high low in the middle. So this low is down here, this low is above, this low is above, this low is down here, this low is above, this low is above, this high is up here, this high is below, this high is below, right? And that's the common theme between all of them. But what makes intermittent time high, intermittent time high, I don't know if I'm even saying that right, is two things. One is you have that has a short-term high to the right of it, that's lower, and a short-term high to another side of it, that's also lower. And the same is true for this low right here. You see the low is higher and the low is higher. But there is one exception, because you can see this short-term high is higher, but this one's lower. Why is that the case? Why is this intermittent term high? Because by our previous definition, the high would have to be up here for it to be valid. But the exception is that when price rebalances a fair value gap, that is an intermittent term high. Right, so this is an intermittent term high because this fair value gap from here to here has been rebalanced by this one extreme here, which then creates this as an intermittent term high. And the difference and the benefit of this is that here we can see that this is a weak market, because if this was a strong high, if this was a strong bullish pressure, then the ITH would be higher than this. That means there'll be a lot of bullish pressure, but that bullish pressure could even break the short-term high, right? And because we are bearish in this instance, we should be expecting that a couple of things to happen. Price should not be taking out this long-term high, right? We shouldn't be taking out this high up here. So we can, every time price comes up, we should expect it to not take this out. And the same is true for the intermittent term high. The short-term highs and lows should not be taking out the ITH, right? So when price comes down here and comes up here, we should know that, okay, well, price shouldn't take out this ITH over here, right? Because we have a bearish bias. Same is true here. We have this ITH here. So when price is making this move up with this red box, we should know that, okay, well, this is ITH, so price shouldn't even break above this. And that's why price then comes back down. So that's the key terminology where we learned about those key terms. So this is the same chart, but on the 15-minute time frame. Essentially, I was zooming in. And this is to help us as well to forecast where price can get to. So we draw a range from this large lower LTH up here and the LTL down here. We form a range from this, or even from the range that caused this move, which would be from LTL to the ITH. And then we use these fear values to forecast where price can get to, and then we can target these levels over here. And you can see there's many times risk over what we would have put for our stop loss. So over here, we can even zoom in into that red box that we drew on that move upwards, where we're expecting that price should not take out the previous ITH. And when we have market structure, when we're good at reading it, you can sometimes get ahead and predict and forecast the market and position yourself rather than waiting for certain confirmations, because our entry model is that you have a displacement and then you have a retracement into that range, that displacement range, and then the market structure shift you have takes out the previous low. But sometimes we don't need that. We can get in, for example, here. Yes, it's an aggressive entry, but it is valid because this STH, we're expecting it to not take out the ITH that's above it to the left side. Just to remind ourselves, this is the ITH I'm referring to. This is the red box. So we're expecting that price would not take out that ITH up here. And for that reason, when price displays downwards, we then have that breaking of these lower term lows over here. And we have this displacement range anyway, which is basically us using the model for it's kind of like using the model for entry purposes. So when we have this displacement here, we then pull back into it, and then we can enter aggressive shorts here. We then have another opportunity where price displaces over here, the price comes back up into it, and because it's a volatile market, we shouldn't expect price to be super clean, right? But we come up to it, and then we sell off again. So the same can be done when we go into smaller time frames as well. This is a range, and the reason why we have this here is because you can see that price moves in this pattern. Now people call it lower lows, lower highs, that's fine, but we see it as institutional order flow, right? So our support, our resistance is different. We use institutional order flow as our support and resistance. So when we're entering sells here, and price comes back up to these red or bullish upward candles, we expect orders to flow in and institutions to protect their orders by entering the markets again at these areas of bullish candlesticks, because this is where they originally got in. You can see by this displacement, that's true. And when price returns, you would expect more orders to appear. And then that's why the number of displacement appears. And then price doesn't come up to these. So essentially what we're looking for is we are paying attention to how price treats these areas. Okay, and until the market tells us otherwise, we keep riding the market to the downside until while these kind of upward candles are protecting price. Okay. And then some just mental notes over here. So essentially what we're doing is we're blending all these ideas together, which can seem kind of daunting, especially when you don't have practice, which is why we have the markets open here. We want to sometimes try to implement some of the things we learn. After we get a little bit tired, we use that as a break format to utilize what we've learned. And we always want to start with a daily, because sometimes we don't put as much importance, especially, and I'm speaking from experience, I don't sometimes put as much importance as the long term, because I'm just thinking, well, intraday changes so much. It has so many small volatile movements. If I can just gauge where intraday is going, I can just make profit. And that's true, because I have winning streaks, but you can also go on losing streaks when you're going against the daily bias, because that's where the institutions mark these kind of areas of liquidity and targets from. It's on the daily chart. Another key mental note is to have a goal. Like here we have this sell side liquidity as our target. So when price takes us out from this imbalance, right? Remember, came up to full this imbalance, and we're targeting these sell side liquidities down here. When price then moves down here and it hits this green bar, we are out and we take a break, because we don't know if price is going to go up or down at this point anymore, right? Now overall we're probably bearish because we are in a downtrend, right? But you want to be careful, and if you don't know, leave it. And the way you kind of know is this: you kind of argue both cases, like you're playing both sides. And what you'll do is argue bullishness. Well, we've engulfed this candle, we've taken our sell side liquidity, and there's resting liquidity above these kind of highs over here, right? But then you can also say that, okay, but we are in a downtrend. You can see by the market structure we've broken these lows down here, and the market structure shift has been relevant to the downside, and we've also been moving for the downside. So you also could have that as an idea. So you want to see which one is more reasonable, and the one that's more reasonable is where it's more likely to go based on your analysis. And that is where we need to put a lot of work in for our personal goal, is to know where the bias should be, because you can avoid a lot of silly mistakes. And yeah, leave that as is. So that's the review of last episodes rather. And we're now ready to go back into episode 13. So let's get started.
Basis as to what I'm doing when I'm doing these executions. When I'm running these demo accounts up really fast, what am I doing? How am I doing it? I got a lot of questions as to how I ran the $10,000 account up to, which was at $256,000 this morning. But it quickly got to a point where it no longer can be appreciated from students' perspective, which was at $256,000 this morning. But it quickly got to a point where it no longer can be appreciated from students' perspective. It's too fast of growth, and the acceleration just makes it, well, you have no connection to it. If you don't know how to do this and you're new, and you start seeing velocity in equity increasing, even though it's a demo, it does not matter. The same principles are applied, whether you're trading with a live account or if you're trading with a demo account and you're learning. And I want to take you into what it is I do and how I'm able to run the equity up quick. What is the mindset behind what it is I'm doing? But before I get into it, let me remind you what I stated last night in the video. Because of the heightened volatility, because of the uncertainty and the likelihood of price action moves that would be unexpected even for me, because it's already delivered what I wanted to see happen anyway, and I'm technically bearish on equities, I don't feel confident or willing to risk, after being profitable in live trading, going short this market, making my February gain. I don't want to go in and risk that because it's already arrived down below these lows. So there's an objective I look for the week. There's an objective I try to aim for the day, and there's something I'm aiming for a goal for the month. So truth be told, the account that I'm showing with TD Ameritrade, I'm trying to illustrate in my best ability to pantomime how it would likely be for a new student if they were to try to do live trading with a model and aiming for 20% per month. Now, some of you are going to think, well, 20% isn't a lot of money. It's not a lot of money. Well, 20% isn't money. Okay? It's a percentage. So I don't care if you start with $1. If you make 20% consistently, the compounding effects of that is astonishing. Now, is it my belief that my students can consistently hit 20% every single month? I would never go out on a limb and say that. I might not hit 20% one of the months, but that is a goal that I'm aiming for. And if you're a new developing student that have worked very hard to find and refine your own model with the things I'm teaching, and you have a trading plan that is well documented, you know what it is you're doing when you're not going to do something, you have a complete understanding of what it is that's going to allow you to engage or not engage in price, then how to manage that risk, all those factors involved, and you've been consistent with a demo account for 6 months. Then and only then would I, not necessarily that you need to do this, but I would then only at that time consider maybe going into live fund trading. But I don't ever tell my students. I never answer an email when they say, do you think I'm ready to go into live? I don't answer those questions. I say, I don't know, you tell me. Or generally I ignore those emails. because there's never going to be a record of me saying, I think you're ready to go into live fund trading. And then when they blow their account, who are they going to blame? Naturally, the human is going to say, well, it wasn't my fault. It was the guy that told me I should do it. He told me to jump off the bridge. So I never put myself in that situation. Okay. And I don't think any mentor or educator worth their salt would ever tell you to go out and risk life money, because experience has taught me that I got into live trading way too fast. Way, way too fast. 1992, that was the worst thing I could have done for my development, was rush to get into real money trading when I had no idea what I was doing. I tricked myself into believing it was so easy, reading one book, no real back testing whatsoever. And I was like, well, I can see this 1, 2, 3 top and 1, 2, 3 bottom idea. You can see it. Yeah, I saw it. 1, 2, 3. I was gone in my first trade. 50% history. Goodbye. Close the account. Send me my money. I was afraid. But when we understand what it is we're trying to do, obviously, it comes with a great deal of nervousness and anxiety, because you have not put the time into back testing and then forward testing it with a demo account. So if you feel this tug of war, this butterfly feeling in your stomach where you can't relax and you're engaging in the marketplace, you're not ready. And that's the bottom line. You're not ready. You have to desensitize yourself with the results not being a factor. If you lose, it doesn't make a difference to you. You're indifferent to it. And it doesn't seem possible that you could be indifferent to losing money. But a student that has a solid price action model, a trade plan that's well documented, they know what they're going to do, why they're doing it, what they're waiting for, what will cause them to push the button to get in, where their stop loss is going to be, how much they're going to risk, what they're going to aim for, where their partials are going to be, if they're going to take partials at all. You have to know those things in advance. You can't determine them once you enter the marketplace. And that's what retail traders do. That's exactly what I did in 1992. I got into a trade, and then I tried to figure out what I was supposed to do once I was there. I want you to see what it is that I was showing last night. And even though I'm not personally willing to risk my live account right now because of the conditions that we have at the present, Ukraine, all that business, all the uncertainties, potential black swan event, anytime can pop off. And I don't want to expose myself to that measure of risk, especially since I have hit all my numbers. The market has delivered to what I expected in my analysis. So I'm not worrying about trying to get in and do anything else. So how do I manage that desire to get back in and do some more? I go right to a demo account. I work inside of a paper account. It provides me context. It keeps me glued, obviously, to what the market's doing. So I'm staying plugged in, if you will, close to the market, being able to read the tape. So that way I can answer student questions. I can still teach around what the market's doing right now. And that way my students can still appreciate the level of depth that I'm providing. But I'm not taking on monetary risk when I don't believe it's wise for me to do so. Because I'm wrong. Let's say I'm wrong. And I traded today with live funds, or I traded on Monday, and I lose what I gained in February. That would eat at me all through the month of March. So it's toxic thinking. And I learned that the hard way many years ago. So what I'm going to show you, obviously, is executions in the trading view, trading account. But I want to make sure you understand, because it's so many people out there that have this issue with me teaching a demo, which is compliance. Like, I'm not licensed to give you trade advice, so I operate through the function of a demo account to protect me and protect you. You know you can't make that money. You're not following me in a trade, so if I was wrong, you don't take a financial loss. And if I'm right, you can't make money and get tricked into thinking that the only way you're going to make money is to follow me. So there's a balancing that's being done there. And if I'm wrong, if I don't know what I'm doing, and if these things don't work, they'll fail on demo accounts just as easily as they would be failing in a live account. So with that foundation laid, let's go into the discussion. So the idea is, we went below this low. I don't want to sell it short, even though I'm bearish. So what's it likely to reach up into? Well, I'm thinking it could potentially trade up into this opposed candle here. Okay, I'm thinking it could trade into that, the low or the open of that candle. So that's kind of like a magnet or withdrawal on liquidity. So it also could reach up or withdrawal on liquidity. So that's kind of like a trade into that, the low or the open of that candle. So that's kind of like a magnet or withdrawal on liquidity. So open of that opposed candle here. Okay, I'm thinking it could trade into that, the low or the open of that candle. So that's kind of like a magnet or withdrawal on liquidity. So it also could reach up into this little area here, because there's a fair value gap there. Just like we had it here and build in. It can go right up into this, go right up there, and then still resume going lower. It might need to go up into that. So I went in this morning and I was watching the NASDAQ and evening S&P. Evening S&P had a lot of energy to the upside, and usually these markets move in tandem. That means they're generally moving together. And even though the NASDAQ was a little bit lethargic and wasn't trying to go up as quick and as fast as ES or evening S&P, the tendency is that it will be drawn to the same degree that the other indices were. So if ES was higher, NQ, which is NASDAQ futures, should be brought higher in sympathy. All boats rise in high tide, basically, is what I'm saying. Now, if we look at the hourly chart, this is what I was seeing. I was trading all this in the demo account, and it ran up into levels that it became absurd now. So I satisfy my itch when I'm not trying to trade with the live account in the demo account, and I'll run them up real quick. There is no fraud required, and none of those things are required to make these things compound and blow up really quick in terms of the equity increases. But I'm going to show you how, even with a micro account. So you haven't already noticed, this is the micro E-mini NASDAQ. So every 1 point or 4 ticks is equivalent to $2. Okay, and I went in with the idea that I'm using a micro account with a discount broker, and the discount broker I'm hypothetically using while I'm taking these executions is I'm hypothetically trading with an AMP futures account, and I'll show you their margins and show you the details of what I'm basically implying by doing these things here. Down close candle. After a run up, we retraced, went down inside this gap. See that? This area here, when it trades down towards this gap, this is the draw on liquidity up here as well, near term. So above these relative equal highs, we have what? Buy stops, or buy side liquidity. So I'm thinking that the algorithm is not letting price go lower. So it's going after everyone that's been profitable going short. So where are their stops? Right here. So we're just going to call it 14,110. Okay, real simple. So the market starts to rally and leaves this down close candle. I'm going to watch to see if it can trade back down into that, because if it does, I'm going to treat that as a bullish order block. Remember what I taught last night? If the move has been bullish, down close candles should not be violated. Down close candles should not be violated. They're going to act as support. Bearish market moves, up close candles should not be breached and broken through. Never even come back down. So when you're bearish and you're watching the market go down, and you see candles starting to form, a potential up close candle, you as a neophyte that is new to trading, these are the moments where you get scared and you basically snap yourself out of the desire to hold the trade, and you just collapse the trade because you can't handle it. It's that overwhelming uncertainty that eats at you like mental cancer. It just literally makes you want to just get out of the trade, even when you're profit. You ever feel that? The trade's profitable, and you're like, I just can't stand it anymore. I gotta get out. You're making money. Your trade is profitable, quote unquote, in a demo. It's worse when you have live account funds and you have a profit, because if you don't have the wherewithal and the experience of submitting to these ideas and watching them come to fruition over and over again, months of experience, not just a week or a day, you're going to feel like you just want to collapse the trade. So when I teach my students, when you're looking for a price move, it's going to be a long-term price swing. Not that this is a long-term price swing in the sense of time, but on this time frame for 1 hour, this is a nice decline. It's a prolonged price swing. It's not like little tiny little movements in here. And vice versa, we have it here. It's going higher. So all down close candles, does it go below this down close candle when it starts to retrace? No. We expect this to be areas where they're going to accumulate more long positions. We retrace, going down into an imbalance, and the market rises above the down close candle. Does it support price? Yes. Time of day is important. So I'm watching when price comes back down into it here. I'm taking opening price and extending out in time. When that occurs, then I know I have a setup where I can go long. But I want to go into the time frames a little lower than the hourly chart to give me a little bit more context, because we do have a low that has a higher low to the left and a higher low to the right. So that makes this what? In return, low. This retracement here, this might be trading into an imbalance, which is what I'm teaching you to look for. But the overall market structure is it's likely to go higher and aim for one above these highs. Buy side liquidity resting right up there. So we're going to take these levels. This red level is anchored to this here. Relative equal highs. Buy stops are above that. Rallies, comes back down in. We're looking to see if it wants to run through that. Notice this high and this high. It creates what? Relative equal highs. Retail-minded traders are going to see that and say, oh, this is exactly what the textbooks say about resistance. So it's acting as a ceiling. Price acting like a ceiling. What should they expect to see price do? Go lower. So here's that level where the buy stops are. Or above it, rather. Here's that hourly down close candle, which is the bullish order block. Notice the down close candle is made up of two candles on the 15-minute time frame. Price moves away from it, goes above it right here. Does it create an imbalance here? Yes. That is how you determine your high probability bullish order block. It must have the imbalance coupled with the down close candle and the underlying narrative that it's likely to go higher to reach for buy side liquidity.
Use the mouse.
Okay,
Use the mouse.
that's it. There is no engulfing candle does this.
Perfect. That should do. Make a note of that again, even though I'm pretty sure I made a note of it, but the idea of
Just forget all that. You don't need that. Okay, it's the gap plus the down close candle plus the idea it's likely to go up for buy side liquidity. That's it. Okay, so I just noticed, by the way, there's a guy out there trying to hawk a $7 indicator, and he says he's the real deal, and it's all about order blocks. And I might change the name on that. Just let you know. So we're trading down into this imbalance here, but now we're doing it at the time of day after the equities open at 9:30 in New York time. So volatility, the initial move is technically the incorrect move going into the opening at 9:30. So this is like a Judas swing. So think about what we're seeing here now. The market's likely to go up above this level here to take the buy side because the market's unwilling to go lower. The algorithm keeps pressing higher, 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 higher. It retraces down into the 9:30 opening. This is that fake move. Don't chase this, and don't chase going higher right before the equities open at 9:30 either. So you have to take a step back and figure out what is you're looking for. Well, I'm looking for a discount market. Low to high. I'm below 50%. Yes. I'm inside the order block. Yes. The equities opening has happened. I'm bullish and it has traded lower. So public is going to be thinking what? It's resistance. It's going to keep going down. To what? There's your support level because it bounced there last time. So they're going to think there. Well, it doesn't do that. Down to a 5-minute chart. It hits the order block and then rallies. What is this? It's your favorite idea. Market trades back down.
Right, so there's quite a few things. First thing is I want to make a note of the time frames. This was hourly. Just to make it easier. And here, there's some properties I want to make a note of. So large.
Down to a 5-minute chart. It hits the order block and then rallies. What is this? It's your favorite idea. Market trades back down and overlaps that gap between this candle's high and this candle's low. This right here, that right there, that is one order block with a lower time frame order block and a fair value gap. You can take that trade if you know what you're looking for and you understand bias, narrative, and where the liquidity matrix is likely to lead to later on, which is drawing up above this red level here. Stops are above here. So if they're going to send the price higher from here and start rallying, that supposes that there's someone that got on board long here. Where would their ideal exit be? 6 points higher? 10 points higher? No. You're going to want to take it up here, where there's willing buyers with buy stops to protect their short positions. So when the market trades above that level, the buy stops become market orders to buy the market, which floods the market with liquidity. For those that have bought down here, they can sell to those willing buyers at a higher price, which they're waiting for down here and waiting for that price rally to go up. Now, as the market goes higher, the expectation is, my expectation was, I want to go long in here and reach for this high. This was my entry idea that it's overlapping, filling in that gap, and it's an order block here with a higher time frame order block there. So there's an hierarchy, higher time frame to lower time frame with the idea framed on it's going higher for buy side. I have an intermediate term low forming, and now this, when it fills in that gap, once that happens, what did I teach you last night? This becomes an intermediate term low. This low should not be taken out. Once it starts rallying, it should not come back down here. What else did I teach you? If price is going higher, down closed candles should support price. Well, it trades above it here. This down closed candle is high right there. It trades above it on this candle right there. It starts going higher. But then look what happens. It starts to go back down. It might go down here and stop me out. I'm not thinking that. I'm looking at this down closed candle thinking it's only going right back down into this down closed candle to accumulate more long positions. So smart money traders are going to be buying more here, like I did. Rally. We have down closed candles. We went above it. I'm not worrying about the market as long as it doesn't take out these two down closed candles. Trades down, gets real close to that, but does it eat up and go through that range of these two down closed candles? No, it just retraces down into what? An imbalance. Why? So smart money can buy again, like I did. The market rallies again and goes into the bottom liquidity. Order block, trades through it here. Get long. Fair value gap. Order block, retracement. Get long. Order block, imbalance with the fair value gap. Trade back down. Doesn't even come back down into the order block. This is classic. It generally doesn't like to go all the way back and rebound once that goes to the profit objective. So the algorithm only has a small little retracement inside the fair value gap, so you will be a buyer. Just that candle's low. And one right to the target. Now, I know some of you just don't trust me. These are TradingView execution errors, and I'm going to log in to TradingView and actually show you by highlighting these actual arrows. But I'm going to take you down into the charts. All the way down into a 30-second chart, so you can see the grouping of where I actually entered with this logic. Okay. Now remember, intermediate term low is down here. This should never be overtaken until the objective is reached. So all of this price action leg here is I trust that it's going to keep going higher as long as the down closed candles keep price above it. Above what? Above the down closed candles. That's going to be supporting each new leg higher. The market should not retrace back down below those. So what am I saying? For trailing stop losses, you do not want to take your stop loss. Say you bought it down here like I did, and your stop was below the middle of this candle. That's mean threshold of the bullish order block. So I don't think it's going to go down below that once I'm entering. Then it starts around and goes above this candle's high. My stop loss must remain below this candle's low because it can dig into that candle because it's going to act as an order block. Then the market rallies away, comes back down, retraces. Now, if I put my stop loss inside this area here, I'm stopped out prematurely. And chances are you probably.
Let's slow down here. Right. So we're not worried about the markets as long as it doesn't take out. It's a missing term, no. So there's a lot of things, right? I want to make sure I get it correct. So I'm going to go over it again because he's talking about a couple of things. One about this low being an intermediate term low, because I think it's intermediate, by the way. He's not saying intermittent. So I might have to change that. But in the ITL down here is, why is it ITL? Because there's a fair value up here. And this is the extreme. We're balancing it. So on and so forth. And we're expecting the price shouldn't take those out until we get to our target. That's why it's important to understand target, because then you can have that bias, you can have that courage to hold a trade because your target hasn't been hit. So whilst your target hasn't been hit, we're not worried as long as it doesn't take out the ITL. Now I need to be careful though.
You get back in. You think, well, I just lost out on potential profit on this candle right there. It starts going higher. But then look what happens. It starts to go back down. It might go down here and stop me out. I'm not thinking that. I'm looking at this down close candle thinking it's only going right back down into this down close candle to accumulate more long positions. So smart money traders are going to be buying.
Which down close candle? So I wasn't looking.
Looking at this down close candle thinking it's only going right back down into this down close candle to accumulate more long positions. So smart money traders are going to be buying more here, like I did. Rally.
Let's come back.
With the idea framed on it's going higher for buy side. I have an intermediate term low forming. And now this, when it fills in that gap, once that happens, what did I teach you last night? This becomes an intermediate term low. This low should not be taken out. Once it starts rallying, it should not come back down here. What else did I teach you? If price is going higher, down close candles should support price. Well, it trades above it here. This down close candle is high right there. It trades above it on this candle right there. It starts going higher. But then look what happens. It starts to go back down. It might go down here and stop me out. I'm not thinking that. I'm looking at this down close candle thinking it's only going right back down into this down close candle to accumulate more long positions. So smart money traders are going to be buying more here, like I did. Rally. We have down close candles. We went above it. I'm not worrying about the market as long as it doesn't take out these two down close candles. Trades down, gets real close to that, but does it eat up and go through that range of these two down close candles? No, it just retraces down into what? An imbalance. Why? So smart money can buy again, like I did. The market rallies again and goes into the buy side liquidity. Order block, trades through it here, get long. Fair value gap, order block, retracement, get long. Order block, imbalance with the fair value gap, trade back down, doesn't even come back down into the order block. This is classic. It generally doesn't like to go all the way back and rebalance when it's that close to the profit objective. So the algorithm only has a small little retracement inside the fair value gap, so you would be a buyer. Just that candle's low. And it runs right to the target. Now, I know some of you just don't trust me. These are TradingView execution errors, and I'm going to log in to TradingView and actually show you by highlighting these actual arrows. But I'm going to take you down into the charts, all the way down into a 30-second chart, so you can see the grouping of where I actually entered with this logic. Okay. Now remember, intermediate term low is down here. This should never be overtaken until the objective is reached. So all of this price action leg here is I trust that it's going to keep going higher as long as the down close candles keep price above it. Above what? Above the down close candles. That's going to be supporting each new leg higher. The market should not retrace back down below those. So what am I saying? For trailing stop losses, you do not want to take your stop loss. Say you bought it down here like I did, and your stop was below the middle of this candle. That's mean threshold of the bullish order block. So I don't think it's going to go down below that once I'm entering. Then it starts around and goes above this candle's high. My stop loss must remain below this candle's low because it can dig into that candle because it's going to act as an order block. Then the market rallies away, comes back down, retraces. Now if I put my stop loss inside this area here, I'm stopped out prematurely. And chances are you probably wouldn't have the wherewithal to get back in. You think, well, I just lost out on potential profit. I made a little gain, but I'm afraid to get back in now because it took me out. That's infancy. That's because you don't know what you're doing. Everybody was like that. I was like that. But you grow out of it. If you do the same things I'm teaching you over time, it's built into your understanding and it's ingrained in your understanding about price delivery. The market rises above, takes out these two down close candles. Now the stock can be raised from whatever would be below this down close candle. Now it can be raised below this down close candle. Because the idea is these down close candles are one order block that should not be violated if it's bullish. If it comes down and breaks the low of these down close candles, well, there you go. You probably did the right thing by getting stopped in. Because it might be failing and going lower. How's that for logic? You're not going to be perfect. I'm not perfect. Even though you see these arrows on the lowest candle here, and it goes out to the exit here, right above that, this is not photoshopped. I've never had to do a Photoshop. Okay, I've never had to do that. But I'm teaching you the logic right out of last night's lesson. I went right into the market this morning. No, it's not done with a live account. But I'm showing you in theory with the application of a demo account, which is the same live data that would be utilized in my TD Ameritrade account or your live account if you have one. These candles are forming just like they would be in your live account. But I'm executing with the logic I'm teaching you right out of last night's lesson. Now, here is the 1 minute. Minute chart. All right, so here we're over in TradingView. Everything is live printing right now. This is where we're at the moment. It's just hanging around that old high. Now, I'm not upset I missed this move here. I could care less. I'm going for logical places where liquidity is going to be resting, and I'm entering in logical places that would reasonably expect to see price advance higher from where I'm buying. It's not complicated, but watching last night's lesson can feel like you're trying to learn a foreign language and expected to understand how to speak it fluently 2 hours later. Don't let that happen, okay? I can make these lessons as deep as I want them to be, but I'm showing you how I'm taking very complex topics and simplifying them in a manner that hopefully is easily received by you as a student. So I showed you the hard perspective last night. That's advanced market structure. Now I've simplified it within the scope of what I teach on this YouTube channel. Do you see the difference? It's only in the matter of how I'm teaching it, but it's the same things. It's the same ideas that I've just simply made it easier. I created a language that helps me communicate what I taught last night in a much more palatable method. So that way, it's not as complicated seeing it like this. This makes sense to you all. You're like, okay, now we're back into this stuff. It makes sense now. I'm teaching you the same thing I taught you last night. I'm just not teaching it to you at the degree that is in my head. You might be thinking, well, keep it to yourself. I don't need to see it like that. And that's okay. I get it. It's fine. But this right here, these are the elements that make up really simple, logical setups that repeat every single week and many times every day. So I ran up the other paper trading account to like $200,000 this morning, and I was thinking to myself, okay, now we're in territories. It's just going to feel silly. You're not going to have any interest in seeing that. At that point, it becomes, okay, now we're absurd. It's just ridiculous. You're not going to believe that this is possible. Or maybe some of you do, and you think you want to go out there and try to do the same thing with your live account. Either one of those things are not my goal, okay? It's just me losing myself in price action. So I treat it like a game. It's a puzzle. So I'm looking for the outcome of a specific trading session or a trading day, and I'm trying to navigate those candlesticks, and that's what you're seeing here. If I hover over top of these little arrows, okay, you can see that they're not photoshopped, and you make them appear by going into the TradingView settings and you click the little execution box here. Watch below the swing lows and above that swing high. You'll see them toggle on and off, toggle on and off, okay? So this is proving precision, number one. It's proving theory in action, and it's proving that it's not flawed logic. None of this is retail, absolutely none of it. There's nothing here that's Elliott wave. None of it's harmonic. None of it is supply and demand. None of this is Chris Lorre stuff. I have a lot of Chris Lorre students, lots of them. And I'll tell you, this isn't even taught in his stuff either. So with that said, let's go over to the paper trading account. This is just, again, illustrate for the folks that say, well, you can't really grow an account if you're using micro accounts. And that was some of the comments I got also. And I'm like, stop thinking you need a lot to make a lot. You don't. You need to be able to compound.
Yep.
The things that you see me do in these accounts in there being parlayed up really quick, every time I'm buying, like I bought right here. Let me see if I can get this to go for a second. When I bought the 3 micros here, the next time I see a buy signal that's below the area I'm aiming for, above that red level, I'm going to try to buy more. But I'm not going to buy more than 3. I'm going to buy now 2. I'm pyramiding. I'm building the biggest position initially, and then every time I buy in, again, I'm building it with a smaller position than I had prior to the one I'm entering now, because I have all the equity behind that entry with 3 supporting the 2 I'm buying here. So even if it starts to retrace too deep on me, I have the ability to weather a little bit more. Whereas if I say I want to be a buyer of 1 here, 2 here, 3 here, that's an inverted pyramid. It's not stable. Imagine a pyramid upside down and it's balancing on its point. It's not a solid foundation. It's wobbly. So I'm building the biggest base at the bottom of the pyramid,
Like that.
position size, It's initial position entry. So I'm buying 3 here. Then I'm buying 2 here. Then I'm buying 1 here. And then I'm letting it run to my profit objective.
Okay. So how do we start? So first of all, let's just start by making this a 1 minute chart. I don't care. I'm not trying to make it philosophical. I'm trying to teach myself. So I'm not going to word it in the way he worded it. So compounding is simple to this, simplified to this statement. If there is a buy signal underneath below or above, below or above target, we enter with lower positions than my initial entry. So if there's a buy signal below or above my target, I can re-enter with lower positions than my initial entry. What I mean, so remember when he hovered over these arrows, as he went up, they got lower in power. So this was the biggest initial investment or lot of position size, and then here was 2, and then here was 1. So it reduced as you went up, which made a shape of a pyramid. So this lowering of positions on compounds is due to the idea of a pyramid that is strongest at its base as to inverse what we did, start small and increase. We are putting the point of the pyramid at the bottom, which is unstable.
Okay. With that said, starting with the hypothetical $10,000 account, just this morning, over 21%, 1 trade with 3 scale-ins. Okay, I consider this all 1 trade. I don't consider this 3 separate trades. It's 1 trade. Scale in, largest, middle, last portion. Then it runs to my objective. So the account history starts with $10,000 here, ends with $12,111 demo money. Okay, the history tab shows you here, and if I'm not mistaken, I have everything shown, don't I? Yeah, time, everything's top here, nothing's hidden, none of that. And then you can see over here, all the business there. Okay, so my question to you is this: who cares if you got to trade a micro account? 3 micros, 2 more micros, 1 more micro. That's 6 micro contracts. That requires technically $1,200. So I really didn't need the $10,000 to do these trades, but in my mind, with proper leverage and money management, $10,000 with this position size and gearing, that's optimal. Anything more than this would have been too much leverage for that account. And to make 21% plus in 1 trade, who's going to argue against that being, well, above average? Now, what happens if you do that once a week, and that's your trade, and you stop? And once you hit it, you end your trading, that's it, and then you go to a demo account. Do you have any idea the leaps and bounds that you can have in your equity increasing and the peace of mind knowing that you don't have to overtrade? That's what I'm trying to cultivate here in this community, folks. I'm not trying to.
Does it stay though? Or it doesn't?
create monsters that day trade every single day. Because I say these likely form every single day, they absolutely form every single week, that is not an invitation for you to go out and say, ICT said trade every day. No, it's not what I said. I'm saying if you miss a trade, you're likely to find one tomorrow. Well, not tomorrow because it's Saturday, but you know what I mean, the next trading day. So there's a balancing act that you have to have when you're listening to me. You just can't take one comment that I say and take it completely out of context and say, well, ICT's a day trader, and he's proven he's really precise, these concepts work. I watched a couple videos, I trust it, so now I'm going to look at the charts, and I think I see it forming right now, and I'm going in, all in, I'm in it. And then you're sitting down writing an email to me saying, I blew my account. Whose fault is that? It's not mine. It's yours. When I blew my account, it wasn't my broker's fault. It was mine. I did not know what I was doing. I was out of control, taking 60, 70 trades in a day. When you lose control and you have no idea what you're doing, it's impossible for you to execute like this. You have to think about these examples as the goal. Not that you want to be this precise right from the beginning, because you can't be. No one is. It takes time to grow into that in your understanding. But it takes some measure of goal setting that you have to have. You listen to some people out there that pretend to be teachers, they'll say, having a weekly goal or a daily goal is the stupidest thing in the world. Really? I guarantee you these people are not profitable that say that. They're hit and miss. They have periods of drawdown that are much longer than most people would be willing to endure. And if you don't aim for a target, you're going to hit nothing 100% of the time. You have to have a goal. So if your goal is to hit nothing, then obviously don't set a goal. But I set very low-hanging objectives in front of me. These things are extremely easy for my capability. And for many of my students from the 2016 group and 2017 group, they can take trades like this. In fact, I have a woman in my group from the first group from Australia that is phenomenal. She does very, very well. And these are trades that I believe that even you, as a YouTube student, in this mentorship on my YouTube channel, I believe in 6 months of practice and looking at price action, you can do this yourself. And do it consistently. Consistently. We mean every day, Michael? No. One time a week finding something like this and working that position like that. Absolutely. I'm making myself available twice a week. This is an extra video today because I know last night's video was a little bit more deeper than you're accustomed to. And I'm not suggesting or implying that the lessons are going to go that direction. I'm just stating that when I'm studying market structure, I'm studying it with that degree and more. But I had to create a language that gets to generally the basis of what that is doing without all the complications within it. So be glad that I'm not requiring you to understand that degree, because the language I'm teaching like in here is accomplishing the same method, just doing it without all of the extra acrobatics. Because I know what you're going to be questioning. You're probably looking at your chart thinking, how do I classify this swing high? Is it image term high versus short term high, long term high? How does he know? Right. That's the part you're never going to get. So I had to create a language that makes it simple. And that's what you see in my lessons on this YouTube channel. I show by comparing and contrasting where I came from and what I'm providing to the public. I can show you just how complicated the real intricacies are behind these marketplaces. But you need to know certain things that repeat and they're very generic in price. They're not linked or built upon without
I don't like that feedback.
anything that's retail logic. None of that stuff. Not support resistance, not any of those other disciplines that people use and you make businesses around selling books and courses and such. So one of the cool things that if you still are a trader that uses like Elliott Wave and harmonics and things like that, if you start studying what I'm teaching you for free right here, you're going to find that your trades that win have my information underneath. And when your trades fail, the things I'm teaching you here are missing. See, this is what I asked last night in closing the video again. The mystery that plagues all speculators is what trading approach is the one that's going to make me money. And I don't have to worry about losing more money in flawed approaches of trading. What you're saying is, there's a method out there that is better than everyone else. I'm humbly submitting to you, you have found it. It's not costing you anything, but it's going to require some work. It's going to require some time, effort. It's going to feel like you can't get it. It's going to feel like you're never going to understand it. That's all normal. That's all normal. But you'll get it. There's folks in my 2016 group that couldn't get it. They got it now. Took them a couple years. Others, they get it real quick. I don't understand why some get it quicker than others. I just know that it's like that. And you might be one of those slower learners. It's okay. I was a slow learner. But once you learn it, it's yours. You don't forget it's like riding a bike. And that should be your passion and your pursuit to get to know how to do this like riding a bike. You can put the bike down for a couple years and then get back on again and just like you never stop riding it. And that's a comfort and a confidence that is something that I can't articulate in words. And if you are able to find consistency and profitability, it doesn't matter what you're doing in the economy's in. It doesn't matter how much it's going to cost you for a gallon of gas or how much it's going to cost you in your groceries, because you can outpace inflation if you know what you're doing in these markets. That should be your goal. Always outpace inflation. And there should be no concern. I'm not promising you rich. Can you get wealthy with this? Sure you can. Am I promising it's going to happen for you? No way. Will you lose money in the process? Absolutely. I'm guaranteeing you're going to lose money. Every trading system, discipline, educator, everybody loses in trading. They take losses. Some take stunning losses. Others just take mediocre losses that are just nuisance. Other traders that are really, really good can have periods of drawdown and then regain that equity drawdown back. And just like it didn't happen. Not even skip a beat. That's experience. These are all bridges that you're going to cross. You're going to cross them at times and intervals that I can't outline in advance for you, but I generally know the concerns and questions you have at this point. My request to you is to suspend those feelings that you have to have all the answers right now, because you don't. You have to be more diligent about placing yourself in front of the charts and backtesting, researching what I'm showing you, because it's there. And by seeing that over and over again, it's better than a book. It's better than a course. It's better than a mentorship that you pay, because I'm teaching you how to go into price, and price will teach you. It will teach you. It's repeating. So if it's repeating and you're looking at it constantly, you are training your eye to see what it does by default. When you buy a book and you look at the examples in the book, each chapter has an idea that it's trying to focus on. How many examples do you generally see? Just a handful at most, right? But remember what
Okie. Apologies for that. Just had a little
Like you got a trading book for the first time, you looked at it and you saw bearish divergence and bullish divergence was the stochastic indicator, and we had a lower low in price, it did make a lower low in stochastic, and it was a bullish divergence, and you're thinking, man, I can see that, that's easy. And then you start looking at it on a black chart, and when you thought it was diverging, it just kept going lower in price. They're only going to show you the examples to help sell the book because they don't want you to return the book. I'm teaching you how to go through price action and ferret out these repeating signatures, and it isn't just a handful of examples, it's every week, every day, and it won't stop. So enjoy your weekend. I will touch base with you on Tuesday, Lord willing, and until then, be safe.
Okay, so just wanted that to kind of end so I can focus on the kind of summarize. But yeah, when you get to the live chart, it just starts to look different because you have all this information. Don't forget, this is just the Google Slides. I also have 7 episodes that are on the Google Docs as well. And you're trying to condense all this information to then go into live markets. It can get tough, you know. Anyway, this is episode 14. We're going to do 14, 15. This should be quite simple. 16. And then 17, I want to hopefully complete before 5 o'clock. And then I will have to cook, shower, get ready, clean. So I don't know if I'll be able to enter this 18, 19. Potentially 18 tonight. I did have a late night, but I also rose up late. So I could potentially have a late night again today. But then that allows us to stream because I won't be as tired. And then 19, well, that's definitely a tomorrow thing. But then 20, 21, 22, if we start early again tomorrow, we can get through a lot of these. It's been an hour mark. I expect us to be able to continue for another hour minimum. Okay.
All right, so I'm going to do an execution. I got requested to show how I use this model. Fair value gap there. We had a market structure shift to the upside. I'm looking for a gap fill from Friday's close. So I'm going to go long here, 12 micros of the mini NASDAQ, or I'm sorry, micro NASDAQ futures contract. So I'm going to look for a price to drop down into that fair value gap and look for a run above 14,160. Right now I have my initial interest at 14,180. I'm thinking 14,220 is possible today. All right, there's my limit entry. Okay, and I'll show you where we're at. So there's the closure of the fair value gap. Now I'm watching price. I want to see it start expanding on the upside. I'm not watching the number underneath that profit. Okay, that's not what I'm watching. I'm watching the candles. Is it constantly going towards that small little fair value gap around 14,122 to 14,138 or so? I want to see it go through that.
Just fair value.
I can start to consolidate in that area and reaccumulate for new longs, kind of like a pausing, maybe think like a bull flag. That's kind of like what I anticipate forming between 14,120, 14,140 in that area. Similar to what we just watched right there. So far, the expansion on the upside solid looks good. I'm thinking I might take the limit order up to 14,220, but we'll see how we trade above the short-term high made prior to 10 o'clock in the morning. Nice little run above new equity high. Nice placement on the entry. It's probably random. All right, buy side sitting right around that 14,160 level that's in the crosshairs right now. Typically, you'll see it usually consolidate around here, maybe a small little retracement. Gets everybody thinking it's time to sell short. Remember, resistance ideas from retail are going to see that 160 and say, okay, I'm going to get short because it went down from there last time. So I'm not thinking that. I'm thinking it's going to like swat, bust through the door and run up into that 14,180. I might adjust that in here. Okay, so that's kind of like my best case scenario. And this is what I'm going to try to take 6 contracts off above here. So I'm thinking if it runs there, I'll take 6 off to fund the position, roll the stops to even, and then see if I can get that limit order at 14,220. Small little consolidation around that fair value gap level, as I mentioned before. Reaching into an order block now.
Could have entered
Looking
here.
at E-mini S&P micro, just to get a feel. Looks like it wants to run as high as well. So it kind of like gives me fuel or confidence that this is going to run up into that level. So I'm going to take my 6 contracts off. And I'm going to change my mind and close it here because it's getting real close to the closure of that gap. I might be wrong, but just for general principles, 14,220 I think is doable. All right, there's the business. Limit order filled. Again, I'll hover over top the entry so you can see it. All right, there is your entry. And that's not bad. It's the low candle. That's what I like to show you guys. And there's the limit order exiting there. So, hope you found this insightful. James, there's your example. Until next time, be safe.
Yeah, I'm not going to make notes on that. It's a pretty quick video. It showed how we entered. It was very simple strategy. Sell stops got taken, market shot to shift to the upside, broke the previous high. We then had the fair value gap. We had the displacement in that market shot to shift, a retracement back into that range of displacement range. A fair value gap is where it formed. We entered on the fair value gap, bought to the buy side liquidity, and then we could have got re-entry if we actually looked at price that came back down to the order block, and he could have got second entry, but then he pretty much delivered to the level he did look for, and he had like external highs he was looking at, but he ended up closing early because of principles, and also maybe, I don't know, I think he mentioned something that he spotted and then that changed his mind. But a pretty simple execution, but he wasn't focusing on price, which is the main thing. And instead of focusing on price, he was actually looking at the markets. Is price doing what we said earlier? Is it continuing upwards? Is it respecting the downward closed candles? Is it using that as a resistance, or is that institutional order flow coming in? And so the things we learned is what he watched, and it was pretty simple to easy to watch. Let me just find out what time frame that was as well.
I might adjust that in here.
That was the 1 minute time frame. So this is an entry. So we don't know the context, but we're assuming the context was good. But yeah, it was a good watch, and we potentially have a good watch here as well. This is a 9-minute video. I want to get done 16 as well before 2 o'clock.
All right, so this is going to be an update to the YouTube channel because there's a lot of people freaking out thinking I'm missing or gone. I'm on vacation, folks, but I took the opportunity to sit down here this morning with you and try to hopefully make a mile marker on the equity on this live account. I'm going to try to hit 50,000. So I'm watching this potentially make a fair value gap. I want to see that swing high broken. And we'll see if we get that here.
Here's in 1 minute.
And again, this account is really meant to show like averaging like 20% a month. I get questions all the time, like, what do I think a student that has gone through all the teachings, have worked out a model, what could they reasonably expect to see, and what could be done without really pushing the envelope? And this is kind of like my answer to that. Also, to kind of like remind everybody, I'm not just finding cherry pick trades in an ML account. I can trade with live funds too. All right, so we're about to break that swing high. If it does, that'll be bullish market structure. I'm thinking we can trade back to, on the daily chart, back to like 14,000, but that's a little bit of a stretch so far intraday. Okay, we have the market structure bullish now. So there's a fair value gap. I'll highlight that. I'll go into the chart here. I'm watching this candle, see how it closes, because that will complete our imbalance. You can see that right there. Okay, give me another. Right there, that's the low end of the fair value gap. This thing's always tricky. All right, so now we have the close of that candle. So now I'm a little off on it because I'm clumsy with Thinkorswim. Change the color here so you can see a little bit better. Now it's technically the open, so it's a little bit of volatility that comes in here. It can overshoot that low. I don't care if it does. If it goes back up into the fair value gap, I will buy it. Okay, now when you're entering on like the opening, like 9:30 equities opening, you could take a long entry here, but you don't know how far it's going to whip below that low, and you could be wrong and painfully wrong. So what I'm watching is, does it want to go below that short-term low it's already created moments ago, which would be outside and below the fair value gap? And it does not negate the fair value gap because I'm using narrative. Narrative is I expect people to look at that and say, okay, it's going to go up, and they're already trying to buy right now, but their stop loss is going to be below that swing low. So sell stops are resting at 13,614. They just took those now. Now, this is a high-risk entry long there, but I'm watching price now entering that same fair value gap. So one more time to see if it wants to poke a little bit lower. And again, my daily bias is bullish, so I'm looking for higher prices. So I'm going to go and aim for the 80 level. That'll give me a nice figure to run to 50,000 on equity. I do believe it's going to go higher, but I'm on vacation, so I want to kind of like, let me take this long entry. And there you go. All right, so now I'm watching price. And I want to see it expand up. Now, because it's the opening, and I don't know where, if we whip below that low, I'll give it a chance to go below it, just by a little bit, and I'll close it at market. Generally, I like to trade with a stop loss, but if I'm trading it open like this, stops can be taken really, really easily and then reverse, and it never give you a chance to be in it. So I'm allowing myself a little bit of flexibility. I'm not trying to encourage you to trade without a stop loss. Believe me, I'm right here ready to click and close it if it trades below it. And I want to see it expand up. Now I want to see an energetic run above the swing high that was formed just to the left of where we are right now. There is a fair value gap at the 680 level, and it's above equilibrium, so it would be a premium market. So that's why I'm going to be targeting the 80 level. Plus, it's
I
around
see.
50 handles, so that gives me about $1,000 or more.
I was wondering why he was targeting that fair value gap, but he answered it that because that fair value gap is within the premium, it is a low hanging fruit for a target. It may not be the overall target. Like he said, he was looking for price to get to 14,000, and one of the comments said it hit 14,000. But he says a bit of a stretch. Not that he can't get there, but it will take a lot of work to get there, and he's on vacation. So those are probably the factors that influence his decision to take it out at 13, well, wherever he ends up taking out, or the targeting is 13,680 level.
All right, so now, right now, at this moment, I want to see it expand aggressively. Not dilly-dally around. I want to see it really try to spread its wings and take off and start moving. There's a small little fair value gap in the last 3 candles up. I don't think it needs to fill that in or even revisit it, but if it were to, I would expect price to be supported by that. So we're not going below the 630 level.
So about this area here.
Okay. Now at this moment, I could put the stop loss on at my entry, and if it takes me out, then I would basically move to the sidelines and wouldn't take any more trades today because it's FOMC. And FOMC you can trade in the morning, but you got to be done early. If you're trading equities, it's important to be aware that that's not a counter because we're probably going to have a lot of volatility later on today. I still think I'll push it higher with that. So here's my limit order. I'm going to place it there, and we'll see if we can get this puppy to reach up there and grab it. I mean, I feel confident it's going to go way beyond that, but short little scalp, very little drawdown, about 3 handles of drawdown, if that, from the entry. Or the candle I entered, I'll say it that way. The low from my entry was only like 3 handles below. I have to go watch the video and see what the actual drawdown was from the point of entry. I'm not sure if I had any. If I did, then that's what it was limited to. $60 or so. Not bad if you're trying to make $1,000. Had a small little scalp early in the morning. All right, and now this is where neophyte traders or newbies, they get nervous. I did the wrong thing here. I always think I'm on the other platforms. I use TradeStation and I use TradingView, and it's different settings, different things you can look for. All right, so there's my fill on the limit order. Rounding out the day and the month of March, I will not be getting any more trades this month. So $1,255 on 2 trades, about $15 or so in commissions. So take that off there, that will be the net for the day. I'll take you over to the monitor tab here. After I scrunch this up to show you the run on the price. Now I think it's going to go higher, but here's the monitor tab showing the actual trades today. And you can see the profit and loss since I started this account and the commissions, which are high because I did a lot of latency tests and I've done a lot of things that would kind of like mimic what a new trader would do once they get into live fund trading.
Let's see the date. So that's March 17th. And this is February. Okay, so it's quite a few weeks. And then this was April the 1st. Bearing in mind, the introduction was done in January. And we are currently on April. January, February, March, April. That's 4 months worth of content we've kind of consumed in, no more than like a month. We've been a bit slow at the start because we were live trading a bit more than we were practicing and studying. Now we're studying, we're not even live trading at all. I like to learn in that kind of environment. So remember, we do have 7 days left to learn this whole thing, and then 7 more days to implement it. Now, the reason why I've given myself those 2 weeks is because when you have a goal, it just helps you obviously to have if I was just learning it, which I was, without a goal, I was just blasé about it. I didn't have a goal like we wrote down earlier. If you don't have a goal, you will hit nothing. And so I was learning without any kind of goal in mind. And because of that lack of goal, I wasn't really on top of my game. And so I implemented it. Okay, let's get that done. And I committed to it on my Telegram, which I actually haven't checked in a while. So future plans, the daily live stream for next time. Wait. Over here, there it is. Mentorship is 41 episodes, hour long each. I'm able to do 1 a day at most 2. Being on episode 5, that's 36 left. So I was on episode 5, April 8th. That is 2 weeks, 15 days ago. So about 2 weeks ago, I was on episode 5. We're now on episode 16. That's 11 episodes in about 15 days. So we've done just under 1 a day, right? And don't forget, we're going to get into this section where it's going to be like 5, 10 minutes, 10 minutes, 20 minutes, like the short ones, right? So after 19, which is very soon. And then what I would expect from then is from a week window, so 8th of May, to start trading again and to continue posting trades, because as you see, I was posting all my ideas over here. Very simplified. You super session, you have a market for the shift, a displacement, a retracement, and we enter as I said. We've got a bit more knowledge than that because we have now biases, etc., what we're looking for and targets, and then how we enter and how we read market structure now, right? So it's a big difference. But this is us on that episode 3, right? From episode 3, this is our knowledge. This is the depth of our trades. And we'll just kind of put into practice the ideas. And we were profitable, which is very interesting. But we do need to now add more depth. And then obviously have the idea of us making a business a month, right? And that's being worked on. So this is our goal, right? So I wrote this on April 8th. It's currently April, let's say 15 days ago. I wrote this 15 days. That's when I made the goal. And that goal is what's been keeping me on track to try and complete this. I am taking these kind of little breaks in between because forget this is knowledge people wait for weeks. They'll listen to an episode, they'll have weeks to implement it, and then they will go back to the next episode. You saw by the fact that he posted one on March 27th and then he posted the next April 1st or 22nd to 1st. They wait weeks in between each episode. I'm doing them literally one after the other. So that's why I'm giving myself these small breaks to give like a mental kind of space. Yeah, so that's it. So 16.
This lesson, I'm going to talk about the idea of multiple setups inside of the trading sessions. So there's a morning session and there's a PM session when you're working with the New York index futures. If you look at the market in terms of a split day, the New York lunch hour between noon and 1 o'clock p.m. New York local time, 8:30 in the morning to noon, that's essentially the morning session. There can be multiple setups inside of that. Now, some of the things I noticed in the comment sections of the videos, some viewers and students are asking, what do I mean by multiple setups? Like, what does it look like? And I kind of like want to touch a little bit on that tonight. Also, I want to give you a little bit more perspective on how you can look for additional ways of trading what it is I'm sharing here. If you're looking at the S&P futures mini contract for June 2022, you can see we recently traded up above the relative equal highs. So buy stops and buy side liquidity were resting right above here. So as the market drove above that, we always have the likelihood of seeing it continue going higher. But whenever it goes above relative equal highs and then we get a swing high like this, that being the high here, lower than the higher candle here, and the next candle after this candle, it has a lower high as well. So it's a swing high, not to be confused with a fractal that's used like an MT4. Okay, that is not what I'm talking about. Okay, that takes more candles to make it, and by then 5 candles later, it's just you've already missed it. So swing high here. Since this candle closes the next day, I'm looking for something to create an opportunity to go short. So we could be anticipating an open here, rally, power 3, which is what I already taught on the YouTube channel, the accumulation, manipulation, distribution, and then incorporating the next level of analysis, which is understanding whether we're going to be in a premium or discount market. Now, obviously, we're in a premium market. We're above all highs here. We really stretched out on the upside. From this high, if we start to go lower, this down close candle is your bullish order block. Okay, the idea of it trading into that down close candle once it goes above these highs, that's favorable. That's something that could potentially happen.
That's packed. That's him. The reason why I want to screenshot this is because that's literally him using multiple ideas into reading the market. So I want to include that system of thinking as a blueprint that we can sometimes refer back to. So let me just add this picture, and then we're gonna get ready to try our best to summarize that information. So the first thing we notice, right, is that this is the daily time frame. So it's even draw that. Okay. Daily time frame right here. Then we need to know that, well, we have, oh wait, that's a lot lower than I thought. But drag that up. So we have buy side liquidity over here. So obviously buy side liquidity from equal highs. Represented by the blue line. Okay. So we have the buy side liquidity above these equal highs. Then we have price that sweeps the buy stops, takes them out. And he's saying that we have a swing high over here. Remember, this is a daily time frame, which is what creates the LTH is large time frames, the daily being one of them. you have a high over here. The high is the previous candlestick from the high in question, the long-term LTH in question. To the left of it, we have a lower high, and to the right of it, we have a lower high. Those are the adjacent candlesticks that are lower than the candlestick in question's high, right, which is the LTH. So that becomes the LTH, right? And he's also looking at the power of 3 over here. So we have a LTH formed, and we have a power of 3 formed, in the fact that we have accumulation, distribution, accumulation or manipulation, distribution or rally. What's it? Displacement? No. I'm trying to find another terminology to describe the move. Expansion. So accumulation, expansion, distribution over here, which is the power 3. And why is that in the case? Because we have this order block, and it's a reasonable idea for price to, after breaking this liquidity over here, to pull back into this bullish order block to potentially rise up. And with the fact that we have a premium market as well, is entitled into those sells. Okay, I'm going to rewind a bit just to see how he referenced that power 3. Was it a reading of the market or an anticipation? That's what I want to see. Maybe he anticipated it because of the LTH. So I want to double check that. So I'm going to start the video back here. And then when I hear that and I clarify some of these points, I can then summarize it and move on.
You can see we recently traded up above the relative equal highs. So buy stops and buy side liquidity were resting right above here. So as the market drove above that, we always have the likelihood of seeing it continue going higher. But whenever it goes above relative equal highs, and then we get a swing high like this, that being high here, lower than the higher candle here, and the next candle after this candle, it has a lower high as well. So it's a swing high, not to be confused with a fractal that's used like an MT4. Okay, that is not what I'm talking about. Okay, that takes more candles to make it, and by then 5 candles later, it's just, you've already missed it. So if swing high here, since this candle closes the next day, I'm looking for something to create an opportunity to go short. So we could be anticipating it.
Okay, so he was anticipating the power 3. Okay, so we have a swing high after sweeping liquidity. And I want to remind ourselves of the definition. Adjacent candlesticks. That spelled so bad. Adjacent candlesticks. Highs are lower. That's the liquidity from equal highs represented by the blue line. We have a swing high, adjacent candlesticks are lower after sweeping liquidity. So we can anticipate a form to go short, despite that after taking buy side liquidity, we can have moves that continue higher, continue on higher. Within that anticipation, we utilize the power of 3. See what he says.
Open here, rally, power 3, which is what I already taught on the YouTube channel. The accumulation, manipulation, distribution, and then incorporating the next level of analysis, which is understanding whether we're going to be in a premium or discount market. Now, obviously, we're in a premium market. We're above old highs here.
Incorporating. Yeah, sorry, I don't know how to say it. That's incorporation, not incorporating. I'll spell it. Incorporating the idea of whether we are in a premium market or not. Fully spelling.
We really stretched out on the upside. From this high, if we start to go lower, this down close candle is your bullish order block. Okay, the idea of it trading into that down close candle once it goes above these highs, that's favorable. That's something that could potentially happen. Now, obviously, I have the benefit of hindsight here, but I promise you, if you study what I'm teaching you, you'll see this repeating. Okay.
So we have the concept of price trading back into the bullish order block, which is a reasonable, what would I say? Reasonable what? Reasonable outcome. We're not going to add the benefit of hindsight.
So the market does in fact trade back into the down close candle. That is your bullish order block. But I'm going to go inside this particular day here, which is obviously Friday. And we're looking at the internals behind what it is I'm trying to teach you and how you can find multiple setups inside of each respective session, the morning session and the PM session. All right, so here is the hourly chart.
Perfect. All right, that summarized all of that pretty well. Did it for me, nice. So this is the hourly chart. So let me see, does he add anything? Grab a screenshot. Grab another one. If I move the mouse too quickly, it opens up that YouTube slide bar, which I don't want because I want to carry the low right here. So let's add this. Let's take away the excess so we can zoom in as much as possible. Then that should be fine. Okay, we don't have much space, so we'll see.
On the S&P futures mini contract for June 2022, and I kind of want to bring your mindset back into what we're looking for, and that is the power three. We're looking for an expansion move, direction higher or lower. In this case, we're looking for it to go lower because we have the daily bullish order block level, that line here, level 45.04. And look at the lay of the land. Okay, what is it that we see also in the price action? Well, if we go to the left, you can see we have relatively equal lows. We have this low, and we have this low here. So they're relatively equal. Not exactly, that's why I named them relatively equal lows. The idea of liquidity resting below here by itself without the order block is likely, but it's further likely if we have a discount rate, which is that bullish order block in the daily chart. So we have multiple factors here leading to the likelihood of this area being probed for the purpose of pairing liquidity, the sell stops basically being rated. Initially in the morning, we were seeing the market trade higher, and then we broke lower, attacking the sell side liquidity here, and then aggressively running into the daily bullish order block. I want you to take a look at this framework from this high down to this low, and this being a fulcrum point, that being if this high trades to this low and we break this low, how far can we go down? I'm going to touch on that in the next slide, but for right now, I want you to think about how the opening price, what's the opening price? Well,
wait, so when's the open? It's a bit difficult to see. So I'm assuming this is midday. So I'm assuming this is open price right here. So this would be, well, I don't know. It's a bit hard to see because it's hourly. I don't know if this is midnight or not. I doubt it's midnight, right? This has to be midnight because it's the date. But anyway, from the open to the high, mapped down would be the, in terms of power three, would be the manipulation and accumulation. So manipulation, but the accumulation would be this range right here, roughly. So when you have that range, you can find setups within that targeting the distribution, which is the area that we've identified down here.
Two. If you're trading index futures, the opening price is midnight at New York time. And that's this candle here. That's the opening price.
Okay, so this is midnight.
And there's another opening price at 8:30 in the morning. The opening price in the candle that begins 8:30. It doesn't matter what candle you use. I see a lot of questions talking about that. Like, what's the opening price? What candle do you use? As soon as you have 8:30 beginning a new candle, it could be a 1-minute candle, it could be a 3-minute candle, an hourly candle, 15-minute candle, whatever that opening price is, that's what you want to note at 8:30. So if you're bearish, ideally you want to see the market trade above that opening price. This is going to be manipulation. Okay, the manipulation is the running above a key level when we are bearish. We're expecting this to go lower.
That's a good definition. But wait, he mentioned something earlier which I thought he was going to use as a definition, which was that when the 8:30 market open rallies above the opening price, that is manipulation, especially when we're expecting to be in a downward market or a bearish market. But he just said here that the manipulation is where price rises or rallies above a key level when we are expecting to be bearish. So instead of opening price, but even though it does do opening price, the definition wasn't what I was expecting. So obviously my question would be then, when you have midnight open at a certain level, let's say 1500, and at 8:30 you then open, and you open higher or lower, but the point is that price eventually gets higher than the midnight open. So when morning sessions open and it either rallies higher than open midnight open, or it opens higher than midnight open, what would you classify that difference as? I know I gave 2 examples, so let's start with one. Midnight open, price goes down, and then when it's between midnight and New York open, price has gone down. But then from New York open, price rallies higher than the midnight open. Are we expecting that continuation? Was that a part of the manipulation, or was the manipulation between the midnight open and the downside moves to the New York open? So the terminology is so it's like I have to put in 10% brain power just to find the correct word.
All of this is basically market retraction, where it's a Judas swing. Okay, the market's.
I would do want to make a note of his definition of manipulation.
Going in the opposing direction that it's likely to go to later in the day. So later in the day, we expect it to go lower. Where's it going to go? Below this low. If it accelerates below this low, where could it go? Below here. Okay, then we have the bullish order block on the daily chart. So we have a lot of things coming together that draw on a great deal of probabilities. Now, probabilities are not absolute guarantees. Okay, that's not the case in trading. If that was the case, I would never take a losing trade. You would never take a losing trade. We wouldn't use stop losses, and it'd be great. But unfortunately, we have to contend with risk. That being the case, we have to at least build the idea around the likelihood of a scenario unfolding, but being prepared if it doesn't. So if this market opening here at midnight and it starts to rally, we can anticipate this selling off. But if it can sell off from here and trade below this low, how much further can it go below these relative equal lows? Obviously, we have the daily bullish order block level here, right here. Now, let me take it back up real quick. That's this level here. The opening price on this down close candle, that's the order block. Extending that line out in time, you end up with this on the hourly chart. So we drop down into that level. Look at the reaction here. It's nice, isn't it? So going below this low, that's the initial target. Then reaching below the relative equal lows over here because that's where sell-side liquidity is going to be residing. Then tapping into that bullish order block on the daily chart. But how much further can we go below that level? How far beyond the actual order block level can we go? Well, I'm going to zoom in on a 15-minute time frame. I've already taught this in other lectures, but I'm going to revisit it here because this is what you're looking for when you're doing your analysis. When everything starts to show a willingness to want to go lower, how do we know it's going to go lower? Well, we have the swing low here, decisively broken. See that? This low, broken hard. Then we trade back up into the imbalance here, so the fair value gap, we trade up into here. At this point, we anticipate the candles past this, or the new forming candles, to trade lower and trade below this low. And if it does go below this low, we're looking at this price point here, that low, as a fulcrum point. That being measuring this high down to that low, that same measurement of distance, and we expect that projected lower. Okay, so this is my swing trading model, and I'm applying it to targeting. So the way you do it is you take your Fibonacci and you anchor to the highest body. It could be open or closed, doesn't make a difference, but you anchor on that. Notice I'm not putting it on the high here, and I'm doing the same thing with the lowest open or close in this swing low. This retracement up, I'm measuring the distance in terms of range with the bodies of the candles. The first time I taught this on YouTube, I had a lot of folks scratching their head and many trolls saying, he doesn't even know how to use a fib. I'm showing you how the algorithm is going to read the price, okay? The wicks and the tails are all distractions. That's all going to be largely attributed to with the, especially if you're trading with Forex, and obviously I'm aware that this is not Forex, but I learned this through the models that I employ with Forex. Now, it's a carryover in terms of analysis because you can apply it here as well. It wasn't always like this. When there was open outcry only and there was no electronic trading, this wasn't as pure as you're going to see and as it's been shown in the past by me in other videos and examples. But by having a measurement from the highest body in this swing up, in this swing low, the lowest body, that means the lowest open or closed, okay? I'm anchoring the fib on that. The settings on the Fibonacci I've included here, and these are the ones that's highlighted for this illustration. So below this low, we're looking for it to run into sell side. So if it goes below this low and aggressively expands lower, this could be your next target, 45.14 and a half. If it goes below this one, we can anticipate trading down to what? 45.01 and a quarter. Now, the question you're going to probably have in your mind is okay, this is all fine and great, but how do you know which one to pick, ICT? If you put 1,000 lines on your chart, ICT, eventually somebody's going to see one of those levels get hit, and then you're going to make a video and say, see how smart I am? I've seen all of your arguments. I've seen that kind of stuff tossed around in the forums and such. So if we look at the idea that 45.04 and a quarter is just below what level? That daily bullish order block at 45.04. Well, at 45.04, and we're getting a measurement down here, that means we can see it trade down to that level here. Now, if you look up here at this level right there, that low is exactly the candle's low right there. Don't take my word for it. Go to TradingView, pull up the June contract for 2022, even the S&P. That is your daily low. You can't predict daily highs and lows, ICT. That's impossible. Well, it is possible if you understand the elements that these algorithms operate under. And my question to you is, can you get any better than that? Is there any other measurement in terms of precision that gets you any closer to 45.01 and a quarter? Not when the low is 45.01 and a quarter. Look at the reaction there. Now, the order block level is just right here, but it stabs down into what the algorithm's going to measure. So there's the order block. It wants to go down to it anyway. There's relative equal lows. It knows there's liquidity down there. And you have the measurement. So the precision element is only going to be beneficial if you have all the other narrative incorporated with your analysis, that being the market's likely to go lower because we ran out those relative equal highs on the daily chart. We created a swing high. We broke lower aggressively. We're likely to trade into that daily bullish order block. Then we have this retracement here. It completely closes in all the imbalance that's between this low and this high of that candle. It rebalanced all that, and then we roll over. Here's that gap I mentioned. Trades up into that. We anticipate what? The candles after this candle closes. We want to see acceleration to the downside. We get it. The market starts working lower, lower, and finally, right on a dime, that candle is that low. And that's your swing projection I teach in this YouTube channel. You will not get that measurement if you use this swing high and that swing low. That's why everybody that uses Fibonacci struggles. Oh, Fibonacci's a joke. It's not a joke if you are doing the measurements correctly. Now, these are just targets, but they are more meaningful when you apply and layer other things in analysis, like the purpose of running to liquidity, below those relative equal lows, into a discount array, which is the bullish daily order block. When you bring that together, you get these types of results, which is perfection. There's nothing better than this, folks. You cannot improve upon perfect. All right, so taking this a little bit further, now we're into a 15-minute time frame. The opening price, again, is this candle here, which is midnight, New York time. The opening price, that candle, you extend that out in time. If you're bearish and you are looking at your daily chart, because the majority of your analysis should be framed on your daily chart, where's it likely to go? Where's the expansion likely to take price higher or lower? That's the main thing you're trying to look for, because that's going to carve out your bias. So if you know that the likelihood of price wanting to draw down to this daily bullish order block, and we have that level of 45.01 and a quarter, which is that candle's low, we don't need to have that yet. But we know that this is going to be a draw on liquidity because it's also below those relative equal lows that I mentioned when we were looking at the higher time frame chart. So all of this here is a build up into the premium. The market then breaks aggressively. What did it create here? What happened here? We had a displacement down. Did that take out that swing low? Yes. Does it trade up into that imbalance right here? Yes. Does it trade above the opening price? Yes. How many boxes did we just check off there? A whole lot. Probabilities are now going through the roof that this is bearish. Then the market breaks lower, trades down to the
I didn't want to actually make a note of the what I'm about to make a note of, but I think it's at least relevant to, for example, if I want to go back and learn, I know where to go back to. Because in this instance, he's talking about mapping of targets using the fib levels. But I didn't really fully pay attention in truth. I was thinking about something else, but I was listening. And the reason why I wasn't paying attention because I did want to I didn't think it would be relevant to what I was going to be going for. But his point was essentially using fib levels correctly and also in line with other information. So, for example, the relative equal lows that is drawn to the left side of the market, which I believe I've got marked, over here. So he was using the fib from this low to that high, but the body of the candlestick, this is the 15-minute time frame. Oh no, on the 15-minute time frame. This is 15-minute right here. To be fair, this might be an hourly. So yeah, he's mapped the high and the low from here to here. Then you'll see with the relative equal lows, the sell side liquidity. I don't have the numbers, it's hard to quote them. Let me see. Yeah, I won't be able to tell. Oh, wait, it's here, 4504. 4504, which is just above here. So it's about 4505, which is over here. This one, 4515, which is right here. It's like a bit lower, like maybe here. I believe this is midnight, right? Midnight open. Price rallies above. We open around here. We break structure, market structure with a balance here. Create this imbalance. Price traces back into it. We actually break below. So we have. So we have a close below this open price. Balance, picking out this low and that low. We then have a close below this spin that open.
Old swing low, sell side liquidity resting below there. Watch what happens. We trade down through it, and then we aggressively rebalance all this down move. We come right back up into it, bearish order block, then sells off another wave into this short-term low, deeper below this low, and eventually, into the lunch hour and past it for the daily bullish order block. Now, when you look at this type of price action, you might not see that as an entry, but it is taught to you in this mentorship on YouTube. That is the lesson right here. Because if you look back here, we have these highs. We trade above it. Does it break below? It does. Does it get an imbalance? Yes. Does it trade up in here on the 9:30 opening? Yes. And then does it run where we want it to? Liquidity and discount array in the form of a bullish order block? Yes. But what other setups are here? Because I mentioned in my Real Money, Real Results series where I was showing actual live account results and proving that these things make money.
Yes. So something I was actually noticing, but before he talks about it, I want to say it myself. So we have this original entry with the imbalance here. Why is this available to take, even though it's not exactly in the midpoint or at the upper bound? We can be aggressive with this air quote. I say aggressive air quote on this entry because we have this. This is intermediate term high right here. We also have a short term high over here because these two are lower. We have a short term high over here. We should not expect. Well, this might be a swing high low key because this is the range. So this is probably a swing high right here. So lower highs on these two sides of this one candlestick. So this high is over here. Then we have this short term high. And then we should expect the short term high to overtake the this LTH, larger time frame high, longer term high. Then we have this intermediate term high. So that's our entry because we had this short term high that shouldn't take out this here. So with the imbalance and this being a fair value gap, we could enter on the edge and then set our stop loss just above the initial first candlestick contributing to the fair value gap, which is actually probably this one over here, but you can sit above this high. Then you have another entry around about here because you have this imbalance. Oh, no. We actually don't. We have this fair value gap here. Boom, boom. Price trades down to this liquidity, creates equal lows. Then, well, I don't know if it came down first or then up. I would not have gone in here. We then have a distribution to this sell side liquidity. Then you have price coming up to this green candle here. We expect this to support price as long as it gets to a bullish order block over here, which is our target. So price comes back up. There's green candlestick, which is your entry because you also have, there's no displacement, but you have this area here of it being an order block. We can zoom into price and then you enter here. To be fair, it delivers. You have a fair value gap, but price doesn't come back up to it in time. It delivers first. So I would say 2 entries. I would get into this twice. Let's hear what he says.
And by the way, I appreciate all the feedback I'm getting in the commentary section of each video, the comment section. But I've read a lot of the questions about, what do I mean by having no more than 4 trades, 2 trades in the morning, 2 trades in the afternoon? What did I mean by that? Because I read one guy, he was saying, I can't even find, 4 examples of this. I may not be saying this correctly, but he can't find that many examples of it forming over the course of a week, let alone a few times in intraday. So we're going to walk through today's price action and show it with clarity. All right, so here's the opening price again on a 5-minute chart. Here's the 15-minute time frame, fair value gap.
There we go.
And the market trades right back up into it above the opening price. That's what it.
So this is better because as some of them I was saying, this might not be a displacement, but it might be on a lower time frame. So here we have the lower time frame. Let's see if we get more than 2. Right. So we have the same system. Obviously, it's the same chart, just on a smaller time frame. We have the open, midnight open, rally up, the manipulation, which obviously is contributed to the power 3. Then we have the accumulation as well. So from this to this to this to this is around about the accumulation range. Within this, we have multiple entries. We have this initial one, which is a little bit more aggressive. We have displacement here. We've drawn. Price comes back up into it once, and then price comes back into it twice. So that's 1 entry. 2. I don't know if, to be fair, this might be contributing to its formation. So I don't know if this is entry, but we have this one. Plus, this is before entry anyway. I mean, open. Not midnight open, market open. So we have this trade back into the fair value gap, which would have been our first entry. We've said why we would enter this one. It's at the right time. It's got the right biases, the right context. Then we have price moves down. Have this bullish order block here. And price trades up to it twice. Once here, twice here. I said this was our second entry. Potentially could have gone in here as well.
What it look like on a 5-minute chart. Notice it does not look clean like it does on the 15-minute time frames. Go back up one more time. See the gap here? And that run right there at 9:30? That, coupled with this time frame, you probably wouldn't see that as a sell. You would want to see this filled in. But you got to look at the higher time frame. The higher time frame, 15-minute time frame, is providing you the framework. It's giving you context that, okay, this is all we need. We don't need it to trade up into that. It could, but we don't need it to. So when it trades up there, then it starts to break down, it rebalances, breaks down again, works into that short-term low, sells off again, retracing it, sells off again. In here, this is your entry at the opening. So in the morning session, you typically have 2 to 3 setups because you have volatility coming in at the opening being 9:30 New York local time. That can be very tricky. If you're not really sure what you're doing, you can get caught up in the initial volatility and offside real quick, and it can run against you aggressively and hurt you. I prefer to see my students look for the initial move to kind of like qualify what you expected. Lower prices, right? So does it give it here? Yes, it does. So how can you participate in something like that and still have a bias behind you and have multiple setups that you can take? Well, let's take a closer look on the lower time frame. Here's the 1-minute chart. Here's that return back up into the fair value gap on the 15-minute time frame, and wasn't so clear with the 5-minute. But now look what we have here. Small little imbalance there. That fair value gap, right above a short-term high. We trade up into that there on a 1-minute chart. You would see that as a setup for the 1-minute chart. Before I go any further, I want you to pause the video. I know some of you don't like to do this because you just want to get through it. You're watching the video at 2 times the speed because I talk slow. This is a time when you want to stop. Slow down because you will cheat yourself out of learning. This is the little moments, like when I'm teaching my private group, these are these opportunities. If you waste them, you do not learn the best way. Okay, there's a good way of learning, and there's the best way of learning. And the best way is actually participating, not just casually watching. Don't Netflix binge watch ICT. This is where you stop the video, ask your spouse or whatever, give you a couple minutes to focus, undisturbed. That way you can pull out the things I'm trying to show you in this lesson. Otherwise, it's just another event where I'm talking about hindsight. But what I'm showing you here is something that repeats every single day. This is how I can go in every single day and take money out of the marketplace. I took the live account up another $1,000 today, so we're over $51,000. And these are the types of setups that you can do. You can find these, and you don't have to have the absolute perfect entry at the opening. You don't need that. Okay, that's the benefit of what I'm sharing here publicly. I want you all to have the ability to feed yourself and your own family, not to rely on a job. If you look for these types of setups with this logic, I am confident that you can do what I just said. And those that really want to supercharge it can take it way beyond that. Competitions, whatever. But we have the logic here. That's that old short-term low. All I did was extend the line out because it doesn't exist in the chart over here because I don't have enough of the data showing. But that short-term low, that was a fulcrum point, remember? That's this low here. So I'm referencing that zone that there's where the sell-side liquidity is. But I want you to pause the video and go through this price action and find the setups that you would see as a shorting opportunity if your bias was in line with what I'm suggesting here, as it should have been, being bearish.
Yeah. I was waiting for him to explain what we were looking for, just to make sure I don't waste my time. So we'll do this, see what he says, and take a break. There's actually so many entries. I'm explaining all the mines in a second. Okay. Explain all my trades. So I would have entered this. The reason why I was saying this one or this entry here, we had a displacement, but we didn't take out this low. So I wouldn't have entered on this retracement. But here we displaced, took out these two equal lows. We had an imbalance here. Price came back up into it. I would have probably taken this aggressively, put my stop loss above here. Perhaps would have came back down. What would price have done? It would have taken me out. But I would have also got in here because we're coming back into this fair value gap or this fair value gap here. And that would be the entry that we have. Oh, it's the same time frame. Wait, it's up here. So yeah, it'll be back into this larger time frame, 5-minute fair value gap. So that would be my entry there. Okay. Then we have just a normal kind of move downwards. We have a displacement again here, taking out this low. What happens? Price comes back, refills this, and this is now intermediate term low. High, sorry. Intermediate term high. Price rebalances this order block, fair value gap, and reaches the order block, and then we sell. Price breaks this low over here, comes back up. There's an imbalance here. We then trade back into it. Enter. Price displaces again to almost this point here. Comes back up to this area here, which is a fair value gap. We enter that sell on this candlestick here to the sell side liquidity. We actually sweep this time. This is create equal lows. That's 1, 2, 3, 4. 4 in our favor, 1 against us. And then we have a potential to enter another sell here if we believe that price is going to this daily bullish order block. We can get in here. If I don't believe it, I wouldn't enter this. Right? Because I don't know if at this point we're going higher or not. So it depends on my moves. I could potentially even take that out because I don't know if I would have been satisfied with this. That's the truth. So I would have taken these trades here. These ones I wouldn't have taken. I would have been happy with reaching the sell side liquidity. Then we have price come up to here, which is this order block here, which is defined by this line. And then it's a bit hard to get like exactly accurate, but here we come up to this place. and then this is the order block, and then we have 1 entry, 2 entry, 3 entry. So we can actually compound here, and then obviously our stop loss will be above this area right here, because that's the top of the order block. Excuse me. So that's all 3 of these trades with the same stop loss, because your entry is based on the fact that price is touching the institutional order flow rather than it actually breaking structure like these previous ones did. They broke a low prior to each one of these entries. This one didn't need to, because we are of the concept of compounding is that if we believe price is going to this daily bullish order block, we would then be treating these areas of bullish candles as an area of support, and that's why we can enter on the touches. So 3 entries here, and you will get another one here. I'm assuming that on the larger time frame, well, to be fair, from here to here is the order block. I mean, fair value gap, and price comes up into it, displaces, price doesn't come back up into this one, but it delivers, I believe, to the order block at that point in time, as you can see from this side of the markets. Oh yeah, it's even here anyway. And then, yeah. So let's see what he got.
Okay, I'm gonna continue the conversation. If you are not ready,
it's probably the only one I would have realistically lost. Maybe this one if I was greedy. I would have won this one, to be fair, but I just took it out because I don't know if I would have, because this has already been delivered, so I don't know if I would have traded this. But again, this is just from the concept of compounding. If I believe it's reaching this order block, if I don't, I'm taking these, all of these.
It's your opportunity. All right, so the first fair value gap here, right there, because we have this short-term low broken with the run low. So there's displacement there, obvious displacement, very energetic. And we have this candle's high, this candle's low, the market returns back up into it. You can go short there and look for what's the first objective, that fulcrum point, that short-term low. Aim for the liquidity, so your target would be there. So you could do, like, say you did 2 contracts, entry here, short here too. You can take one off here, let it ride, and then see if you can get that lower time frame objective later in the day. Now, I don't want to take entries during the lunch hour between noon and 1 o'clock, but you can take profits if you're doing like a partial. If you did one here, if you did 2 short contracts here, you took one off at your first target, and you want to see if you can get the other objective. If you have a limit order at the order block level, plus a couple points, it could fill during the lunch hour. You don't need to be babysitting it, being in front of it then, because you've already funded your position and trade by taking one off here off and moving your stop to break even, and then see what it can yield in terms of the daily range. Next one is here. Another short-term low taken. Fair value gap there. We trade back up into it. That's a short. You can go short here. And again, same premise, looking for the first run below here. That would be your target. Take in there. If you did multiple contracts, you would get short here. Take 2, take 1 off. This might scare you. Not so much probably if you were short from up here, but here could be a little bit intimidating. But if you've taken one of the contracts off below here, even if it were to come back up and take you out and stop you out, the first contract allows you to be profitable. So it kind of balances things out. Another one is here. We have the imbalance here. After we aggressively move lower and then retrace back up in. This is why I'm saying that that previous short, if I was short from here, I wouldn't be worried about this one so much, because your stop would be above here. Now, it got close.
This is why I wouldn't have taken this, because it delivered here. He's saying that's an entry. I did have it circled, but I was just trying to be realistic. In a live market, I would truly be not trying to enter this, because I would have been happy. But I know it can be an entry. It just depends on, literally, if I believe prices go into this daily order, bullish order block. That's the only factor that would be determining whether or not I would be entering this, is whether I believe this. Now, obviously, in a perfect world, I would be trying to get to this, because we have hindsight of price going to this area. But in the real markets, when I set my goals of the whole low-hanging fruit, I might be satisfied with this, because I would have put, let's say we had $1,000. I don't know if I want to really. Hold on. I don't have anything to really measure, but let's say I'd entered all of these in like a 1 to 3. To be fair, this is like a 1. It's like a 1 to 5, 1 to 5, 1 to 3, a 1 to 1. So 1, 4, 9. Let's say 14, and then let's say 13. Well, we made a 1 to 13. We risked £1,000. That's 13,000. Or we had £1,000. We risked 100. Would have made 1.3 with this move here. So I probably would have been happy, to be so honest.
To it, but I've been in many trades over the years where it moved within a quarter of a point without stopping.
One second.
Out. And it's a scary feeling, especially if you have a lot of size behind your positions at the time you're in the trade. But it's still a little intimidating because if you completely fulfill your model and follow it in all the rules, and you don't want to move your stop and you just allow the stop to be taken, there's been many instances in my own trading where within a quarter point it doesn't stop me out. It's not like Forex. These markets are a little bit more professional in the sense that they're much more precise and uniform in the delivery. You don't get these wild, erratic little spikes and spreading, of the price action because everybody's working with the same price here. Versus in Forex, you're trading within a pool of liquidity within your broker's in-house, and they have a little bit of luxury there where they can open that spread on you, and that's why it's a little bit trickier to operate in that versus something like this market here. It doesn't mean I don't love Forex still. I do, but right now Forex is just quiet. It's not doing things that I would promote in my students' attention. I'm telling all my students, both in my private group and you all here, that this is the markets that you should be following. These markets right here, the index futures. I'm sure there'll be a time when we transition from index futures back to Forex, but until I see them loosen up a little bit in the currencies, my attention is here. Okay, so anyway, getting short here. This was a shallow run below that old low, so we anticipate it to run a little bit deeper, and it does. Okay, so you can take profits below this low here. It's a partial. And then you've seen now, obviously, multiple opportunities within the same morning session. So it's also showing you how, if you miss your entry, how can you get back in line with the marketplace and still participate in these moves? Now, there are going to be days where we don't have this many retracements back and back and back, and then it goes lower. It'll be just one or two, and it just keeps on going. Or many times it'll be just right at the opening, and that's it. You missed it. It just goes right to where you thought it was going to go for the day, and you can't get mad about that. You should be happy that your analysis concepts are speaking to you with that much clarity. And just know that because they repeat, none of you should be upset that you missed a trade. Like, none of you. Nobody has the permission, okay? You have no right.
I'm making note of that as well. But what I really liked is explanation of this is that because we had a shallow run of the sell-side liquidity, we can expect this type of pullback because, this deep pullback because of the fact that price is, because the price is just taking out some liquidity. So I want to say the right angle triangle. 212. Okay.
Mass transit buses that come by like a schedule. Every certain time of the hour or day, these buses are going to come around. These trades are just like that. You can set your clock to them. Okay, they're going to form. They're going to be there. Your number one goal is to understand where is it likely to go to. Where is it likely to reach for? If you have that understood, it becomes so easy to know what you're looking for. Notice what I said there? It becomes easy to know what you are looking for. I did not say it's so easy for you to make money. There's a strong contrast there, okay? But by default, over time, once you have been doing the things that lead to you understanding what it is you're looking for, and that part becomes easier, what do you think the default result is going to be from that? It's probably going to be easier for you to make money over time. Okay, so I'm keeping things in balance so that we understand what I'm saying without sugarcoating it and making it sound like anybody can walk in here and do this. It's going to take some effort. Now, you're probably looking at that pink rectangle asking yourself, what the heck is that? Well, that is the PM session buy side liquidity pool. What does that mean? This high here was the most energetic one in the morning session. It took us all the way down to what target we were looking for, the daily bullish order block. Because it's Friday, because it hit the daily time frame objective, it's in a discount market, it's really traded lower. End of week, there's going to be a retracement back into the weekly range. What can it aim for? Well, it can aim for the liquidity resting right here, because a lot of people are going to say, wow, this is the place where my stop should be at, because I want to hold on to this thing over the weekend. Now, I don't know who has the courage to do that anymore. All the things going on around the world, I personally don't have the courage to hold over the weekend. There's just too many things can go wrong. I'm not sitting in a potential opportunity versus 1,000-point gap against me when we start trading on Sunday. No, thank you. I'll pass on that. But this area here is where you would anticipate on Fridays where liquidity could be a draw, because it's going to likely pull back up into a premium. What does that mean? Here's 8:30. Here's the turning point at the 9:30 rotation. So this high, or we could use this high here, doesn't make a difference, but I'm going to use this one because we're framing the logic behind this day being bearish. So this high down to our target. If you put a Fibonacci on this low to high and find the 50% level, this is above 50%. So that means above here, that's a premium. So the market's going to move from what? A discount to a premium. That's what the market does. That's the algorithm does. It seeks discount to premium, premium to discount. Within that logic, the market is reaching for liquidity in the form of buy stops and sell stops, and or imbalances, or the creation of an imbalance, fair value gaps, or returning back to a fair value gap. Okay, that's all these algorithms do, and they do it on the basis of time, then price. Now, that's a gross oversimplification by me, but by far and large, that's all these things do. It's not your buying and selling pressure. Okay, it's not the effects of the DOM. Okay, I got a lot of people asking me because they watch me show things in my live account and they think I trade with the DOM. I don't trade with the DOM. Okay, I'm not looking at the DOM trying to read how many orders are resting above or below, because there's spoofing that goes on.
Oh, that's
and
the
those orders may not be there when
volume.
the price goes there. So I don't think that the DOM is something that is useful.
I forgot what it
I'm
stands
throwing
for
it in
though.
here because I saw a lot of people in the comments asking about those types of things, and I don't use them. I don't use them in my trading, and I don't think there's anything in terms of advantage in using it. If you believe you're being profitable because you are, don't let my comment change your mind, and I'm not trying to open up a dialogue for debate because you're never going to convince me. Okay, so you're okay if you're using it, but I'm answering students or viewers, and that's my opinion. Okay, so I'm not trying to begin a debate about it. Okay, so we have a PM session buy side liquidity pool that the market could likely reach up into, and again, the logic is we move from this high down to a target. It's Friday. There's probably going to be position squaring. They're going to want to take the market back higher. So what are they going to reach for as an opposing move? Notice what I'm saying here. This was the target. There's going to be short covering. Who's short covering? The smart money that sold short here, 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 and here. So if they're covering a short, are they bearish still? No. So if they're not bearish, what are they? Bullish. So if they're going to be smart money and buy down here, or if they're going to use this imbalance in here, if it trades down into that, you can see a run higher. If they're going to buy it, what are they going to target? The buy stops up here. And they're going to sell right to those buy stops. They're buying this and selling it to these waiting buyers on their buy stops. Notice these relative equal lows. They take it into the order block right below those relative equal lows. Because it sells what? It sells the retail crowd that this was support broken. What are they going to want to do? When it trades back up into these...
So I am busy. Give me a second. Okay, I'm gonna have to end stream. I'm on this time crunch and I have a lot to do. I know it's silent for a little bit. I was gonna take a break, play a game with you guys, and then finish the rest of the video. But we're at a decent place to stop. We've essentially stopped before the
and
PM
selling it
session
to
anyway.
these leading buyers and
So we're gonna come back to maybe around here and then we'll continue. Episode 16. We have now 15 more episodes to do in 7 days. So that's about 2 a day, which will be extremely easy, especially once we get past episode 19. Because a lot of these episodes are under 20, 30 minutes. So yeah, I do think it will still be, we still have to be on top of our game. I'll do my best to try and finish this off alongside 17 today. That'll be great. And then 18, 19, we can do over the next 2 days. So then that will be giving us 4 days remaining. And then it will give us 5 days remaining. And then we have 20 to 21 to do in 4. That's like 5 a day. Like from here, so 37, 39, 55, 21, 40, 2, 34, 45, 3. So from episode 26 to 37 is 3 hours. About 11 episodes that can be done in 3 days. 3 plus 2 is 5. That'll take us to 28. So we can get this on the 28th. From 29th to 30th, we have this chunk. So we might go and finish on the May 1st. But we have to put in work, which is fine. We're making good progress. We're not going to go through markets today. We don't have time for that. I'll probably try to structure my day where I can potentially return. But yeah, that's enough for me. If you go to my YouTube, you have all the links in the description or on my channel itself to find any more information that would be relevant to you. Remembering we are growing live. So we have some links here. The Telegram, the Instagram, the TikTok, the website is all there. You can also access it on the stream description. As you can tell from the description, we have the Telegram. Oh, no, we don't have the Telegram. What do we do? Wait, what? This is wrong. We have the website, Telegram, Instagram, TikTok, all there, ready to be used. I need to change this. I changed it, but it doesn't work. Anyway, like the stream if you're here for the first time. Subscribe if you're new. We're going to be going from learning to implementing to making money together to show you guys it's possible. And this is a little bit biased because from this title, you may not understand that I have been trading for 10 years, sorry. So I do have back knowledge of what I'm doing. I do have some skill sets. So that is a factor that is going to be important. Yeah, join my social medias. You'll see more updates there. Starting from May 8th is our plan to do our first post, of which I'm excited for. And I'll see you guys tomorrow or later today. I've said that for the past 2 days and it's always been tomorrow, but you never know. You never know. So see you guys later. Bring boy, see you guys.